Good afternoon, everybody. Welcome back to Schwab Coaching for our next topic, getting started with stock investing. Today, we're focusing on the what to buy process you might consider. I'm your host, Kevin Horner. Thanks for joining me today. You can certainly say hi to my friend Ben Watson there in the chat. He's going to keep an eye on the questions, comments y'all might bring to us as we will work through our discussion here today. I'll try to do the same, of course, for you, monitoring the chat for your questions, your comments, and do what I can to answer those for you. But today's conversation around the what to buy is going to be specific in terms of areas of balance sheets, for example, that we're going to be looking at, things that are things investors want to maybe know about the companies that they might be considering for investment. But what we are not necessarily going to be doing is defining these as the ones to work with, right? We're not going to tell you that you need to use one versus another, and nor are we really going to get into too many nuts and bolts around the specifics of what those details might need to be, meaning we're not going to talk necessarily about the specific PE ratio that somebody needs to have to create a portfolio of opportunistic trades, for example, or investments. We're not going to go that far with you, but we are just going to try and create some understanding around these metrics for you. And I am going to take us into both Thinkorswim Desktop today, as well as Schwab.com. And we're going to look at the research tool at Schwab.com so we can compare some of this data side by side and also use the scan tool in the Thinkorswim Desktop application to locate stocks that will be utilizing these criteria. So we're going to try and put together a number of pieces for us here today. I'm pleased that you're all joining us, and thanks for being here. So, as always, I need to work through some disclosure detail with you all, and then we're going to get into the fun stuff. So I'll remind you, of course, that the discussion is entirely informational and educational. Remember, we don't make recommendations, of course, as I kind of laid out in the intro there. So we won't be endorsing a specific metric for you to utilize, but we do want to make you aware of what these metrics are and why traders and investors alike might utilize them, and accurate for you across the board. So with that, let me take us through what is intended to be our series overview here for you, everybody. And that series is one that you can utilize our archived link for, by the way. We've got a number of videos and content available for you. Our friend Connie Hill was providing this class for you previously. So the archived list is available in the YouTube coaching channel, and you can go back in time and certainly watch Connie's videos if you'd like, or you can be here on Thursdays in the afternoon with me going forward, and we're going to try and work our way through these topics, among others, of course, as we get a full understanding, or at least lay the foundation of understanding stock investing. So this is what we are expecting to get through over the coming weeks. And of course, in terms of today, I expect that at the conclusion, you'll be able to define these common fundamental metrics that we're going to cover today. You might consider how you're going to utilize these as filter opportunities. That is referred to in Thinkorswim Desktop as scanning, and referred to in Schwab.com as screening, but essentially they are the same. So these are how we're going to address things. And of course, as I mentioned, I've got examples that I want to be sure to get to with you all today. So we're going to start with a metric that is probably very familiar in terms of the terminology itself. I imagine if you've had any cursory knowledge of the stock market, you may have easily heard of price to earnings ratio. And it's just the scale that references the price action of the stock relative to historical earnings returns, right? Detail that we're trying to use as a metric or a gauge of the health of the underlying company. Essentially, though, the price to earnings ratio, we calculate this by dividing current stock price in this calculation divided by the earnings per share from the last 4 quarters, and doing so on that annualized basis. Now, you can do this, of course, quarter to quarter, but what we're looking for are consistencies and trends over longer windows of time. So commonly, when you look at a PE ratio, you're doing so as that based on a 1-year return on earnings versus the price per share. Now, the PE ratio, comparing the stock's price to the company's earnings or profits, we can create good earnings, but due to outstanding shares, remember, you can have a substantial number of those shares outstanding, and that can erode that earnings per share. It can also erode the PE ratio. It can also inflate the PE ratio as well. But one of the common approaches incorporating price to earnings ratio is to look at, is with many of these metrics we're going to look at today, we are going to see a consistency of reviewing an equity in a given group against its peers, rather than necessarily an equity from one sector and looking at it as it relates to a different equity in an entirely different sector. And that's because a lot of these sector relationships are consistent. So you might have one group in particular. Let's take technology. Technology is not thought of commonly as value investor opportunities. Doesn't mean you can't find those opportunities. It just means that broadly, technology is a high growth area of the market, and high growth does not necessarily incorporate or mean specifically high earnings necessarily, right? You can have a good growth company that is not necessarily generating earnings on a consistent basis, but there could be the forward belief that they will generate those earnings. And you can find these stocks making very large moves and doing so with things like price to earnings ratios that just wouldn't be attractive necessarily to the average trader or investor. So if I was going to give you a brief example of that price to earnings ratio, if we just took the idea that a company is earning about $100,000 annually and has 50,000 outstanding shares, we would just take that earnings per share figure, taking an approximation of $2, let's say they've earned on a $100,000 investment. So it's $100,000 in returns, revenues, divided by the 50,000 shareholders gets us to $2 in earnings per share. Okay. So that's how we came to an approximate calculation, but you got to remember it's always tied to price relative to the number of shareholders that can, so to speak, lay claim to these earnings as an investor in the company. Now, after price to earnings ratio, we can consider price to sales ratio. Now, this is a tool that kind of helps us understand if the company is cheap or expensive, just like PE ratio, but it's obviously looking at an alternate metric, that being the sales of the underlying company. It compares company stock price to the annual revenues per share, which tell investors how much the value the market puts on each dollar of revenue that a company actually earns. So, of course, revenue, as we would define it, revenue is the amount of money the company brings in from its standard business operations on any given window we're looking at, right? Quarterly, annually, etc. So revenue per share, we define that as that revenue divided by the total number of outstanding shares. So once again, we need to know how many investors own a piece of this puzzle, how many shares are outstanding. So by dividing the price of these securities by the annualized sales per share, we come up with the price to sales ratio. So a price to sales ratio of 1 means that investors are paying $1 for every dollar of sales. A ratio of 3, we're paying $3 for every $1 in sales. If it were half or 0.5, we would be paying 50 cents for every dollar of sales. And so by that explanation, I think it's fair to suggest that generally speaking, the lower the price to sales ratio, the better, because it means the company is generating more sales on a per investment dollar basis, meaning you, the investor, don't have to put out as much money to get the same amount of company delivered return on their sales. So the key to this, again, when thinking about price to sales ratios, is important to once more consider industry and peer groups. So when we are looking, as an example, we will look at the scan tool in Thinkorswim Desktop and utilize that to peek into individual groups of the market rather than necessarily just saying, show me everything that's out there. Because again, we want to have a clear picture of how these stocks react or are handling current market environment relative to their peer group, right? Collectively, aggregately, we often see individual groups moving together. They move in concert, right? Yes, you get a few outliers here and there, but commonly in the broader landscape, the longer term trends, they tend to play out in these broader aggregate groups of the marketplace. Okay, so there's your price to sales ratio. Now, next up, we're going to talk briefly about price to book ratio. Now, current stock price here gets divided by the company's latest period of book value. Now, book value, we should define this, of course, is the net worth of the company divided by the total number of shares outstanding. And we do that based on the most recent quarterly report. Now, this varies widely by industry, of course, as we've stated about these many other opportunities we have to consider the health or valuation of these companies. But it helps investors know just how much you're paying relative to the net value of the company's assets. So that's what we're talking about here, is the incorporation of book value. That's the net value of the company if they were to sell off all assets entirely, meaning company just decides we can no longer do business. We lost our CEO. We don't want to choose to sell, etc. We're going to shut our doors. We're going to close up shop, and we are then going to sell off everything we own as absolute property or assets, if you will, cover all liabilities, and then what's left over, that's your book value. So the basic calculation on that is that we take assets minus liability divided by shares outstanding, and then the price per share we divide back by the book value, and that gives us the price to book ratio. Now, the price to book ratio of 2, for example, would be considered low, whereas something like 10 is considered high and means that investors are paying $10 for every dollar of shareholder equity. So I'm not sure if you all are maybe familiar. You might have come across something in the marketplace where you've heard reference to book value. And as a common example of this, I would just point out, and again, this is not to suggest that traders are looking for these opportunities, but as an example, if you've got a company in the market that is getting beaten down for one reason or another, maybe there's a bad narrative out there talking about something negative associated with leadership or management, for example, and the stock price takes a bit of a hit. Well, commonly you will find stocks trading well under values they should, maybe based on a price to book ratio, meaning if you evaluate it, you say, well, the price is $20 a share. But if they were going to be no longer doing business, if they had to shutter their doors, if they had to sell off every asset, cover every liability, if they would then still have $30 a share in book value, then a value investor might look at a $20 price per share and suggest, well, I have no choice but to buy that position, because assuming the company is continuing to do business and their inventory is not eating into their returns, well, this is a company who is valued at $10 over their stock price today. That doesn't necessarily mean that that's a position that ends up working out for the trader or the investor choosing to step in that fashion. However, it would suggest that a company would be trading, by definition, trading at a discount to their book value. And so there could be considered to be value there for a new shareholder to take on. So I wanted to point that out. That is something you don't necessarily see commonly all the time, but when it comes up, stocks trading below book value tend to be maybe a little bit oversold in terms of price action. All right, so let's move from price to book and talk about return on equity. Okay, so here we're getting a little further down the fundamental balance sheet, right? This is a profitability measure measuring how efficient the company is at generating their profits. We calculate return on equity by dividing the company's net income, their equity, by its equity, excuse me. So this is the net profit that a company generates divided by the book value of the shareholder capital that the company owes. So it's different in consideration from many of the other ratings that we've covered thus far, because return on equity specifically does not take into account the price per share at which it's trading, excuse me. So once more, we want to remind you that when considering return on equity, we should be comparing this to stocks in their tradable space, in their industry, their sub-industry. So we should be using comparison tools to place these side by side. And we can also benefit by looking at historical numbers to see if the return on equity has been rising over periods of time, 3 years, 5 years, maybe 10 years. So it can be what we ideally want to see is a rising return on equity at the same time that we're seeing a rise in net income. So the company is not only growing, generating more income, more profits, but also doing so from a standpoint of becoming more efficient, at this process. Early on, companies will have high growth opportunity, but very low return on equity, commonly simply because they are working to build that efficiency. They are still in infancy stages. It's difficult to have all of those intricacies built into your process that will allow you for an improvement on your return on equity. So that's something that takes a larger window of time, I would suggest. So that's a big important key. Now, if we're talking about small company stocks, small cap in general, companies that carry lots of debt, we need to also give consideration to debt to equity, right? The ratio the company has in terms of its income divided by net equity in the company. So leverage matters, right? And we talk frequently about the use of debt. It's one of the main reasons we see discrepancies in why stocks in the S&P 500, for example, move quite differently versus shifts in interest rates than, say, stocks in the Russell 2000 will move relative to shifts in interest rates. Simply put, small cap stocks on the level tend to carry larger amounts of debt, both in dollars and in percentage of the underlying company. They often utilize that debt to maintain and do business. That much is true. And as interest rates rise, it's a pressure or a headwind on those smaller companies. But the larger, more well-developed companies that maybe have their own pool of cash from which they are drawing, utilizing their own cash on hand to develop other investment opportunities within and outside of their own business, those companies aren't going to have these substantially high debt to equity ratios. And again, if you think about what debt to equity feels like for those of us just on a day-to-day basis, if you utilize debt, you know that when rates are rising, as we have seen very well for the last 6+ months, rates change and it impacts our ability to do business as we've been doing it in the short term, right? So as rates climb, we might be forced to tighten up our belts a little bit. And if rates continue to climb, well, now we might be tightening a little more. And the more we tighten as a company, well, then the less we have access to from a standpoint of maintaining and doing business or spending those funds for the expansion of business. So there's a key measure here in debt to equity, also very, very important to ensure the health of a company, right? To ensure that you can continue to do the business you're doing because you have access to funds, and those funds, you can manage that debt, that amount of debt at the current rates you are locked into. That's a common way to be thinking about things. So it is important to give consideration to debt to equity. And if we were looking for a general viewpoint on debt to equity, generally speaking, investors might use the debt to equity ratio with something in the neighborhood of, say, 25 or less. So you want to see that 25% of that underlying balance of the overall portfolio of the company itself is tied specifically to debt. A high debt to equity ratio would indicate the company is highly leveraged, of course, could be a company at higher risk for struggles, higher risk for maybe an inability to continue to do business, of course. So these are all things that have to be considered. But the reminder I am really compelled to bring to the table here is that while we've looked at return on equity, debt to equity, price to earnings, price to sales, and price to book, that's a lot, by the way. None of these are ideal or perfect in their own right. And so for those of you who are familiar with watching me talk about technical analysis quite consistently, look, we talk all the time about how every piece of the puzzle is just that, a piece of the puzzle. Nothing is going to be that definitive, well, if this ratio is X or better, you've got nothing to worry about. We always have something to be worried about as it relates to our investment process. Nothing's going to work 100% of the time. Combinations of these factors aren't going to work 100% of the time either. But what we're trying to do is just build an understanding of what these numbers may mean to the company themselves and to investors who are evaluating, hey, should this company make it to a watch list for me such that if it's on that watch list, well, then I can migrate that watch list over to my next step, which we're going to get into in another segment of this series, of course, which is if we're talking the what to buy today, after that becomes the when to buy, right? So the idea behind what to buy is really just building multiple lists in multiple scenarios, whether that be stock considerations for growth, stock considerations for income, stock considerations for value. So just going to bring you back briefly to the conversation we had last week around those three methods that long-range investors might consider, right? Growth investing, income investing, and value investing. And so building these lists of individual equities that are suitable for growth opportunity, value opportunity, and income opportunity. Very good process. And then as I mentioned, we're going to go forward with this to kind of demystify trend analysis, which will aid investors a little bit in deciding, yeah, that looks like a opportune time to be putting some money to work in that one area of the market, that one area that I need some exposure. So we will be putting these pieces together for you in a little bit more of a broad fashion as we go down the road. Okay, last up that we're going to talk about here in terms of these ratios and things to be aware of, we also want to be considerate of trade volume. And it is true, like if you're an investor, then chances are you're not necessarily putting money into the market for the purpose of being a seller of those shares shortly down the road. You're probably not even thinking about it from a standpoint of, I'm going to want to sell this when it reaches this price. So if you're not thinking about a sell strategy when you're buying stock, then chances are you're just an investor, and there's nothing wrong with that. If you are thinking, hey, I'm going to put X dollars into this position, and I want to sell it at sometime in the next 12 months, whether that's based on calendar movement or based on price action, I want to sell it when it moves up to this price. That is a trader's mentality by definition. Now, a trader needs to know, hey, I'm buying X many shares. I need to know that I'm going to be capable, most likely, of exiting those shares when that time comes. But an investor might not be as considerate of volume on a day-to-day basis because they're much more worried about just being in the share than they are being able to sell the shares even down the road. Now, it can make sense. And so when we talk about volume, you can take volume from an average volume basis. So as we will show here in Thinkorswim in a moment, but you can utilize average volume to kind of provide you that blanket comfort that says, all right, this is a company trading 500,000 shares a day. That is more than adequate in terms of liquidity for some traders. And they would just say, yeah, as long as that's the value or the average volume, that's a company that I can get behind. Generally speaking, yes, you want more volume. By definition, more volume means more interest in the company. Not always, because you can get volume numbers substantial relative to a price per share, right? You can get penny stocks trading millions and millions of shares. That's not what we're talking about. We're talking about these well-founded companies in major indices and groups that may average enough shares to get you the liquidity you need for comfortable investment in a position and being able to sell that position down the road. So the key here is to set a level that you're probably comfortable with. And, 250,000 shares is kind of small at this point in time. There's a lot of active trading these days. And so one of the factors that I will commonly utilize from a scanning standpoint is 500,000 shares on average. If it averages 500,000 shares over the last, say, 50 trading sessions, that's commonly an adequate amount, especially for the trader who's buying 100 shares, maybe upwards to 5 or even 10,000 shares. 500,000 shares traded throughout the day is a fairly liquid position, but you can always increase that number to a level higher if it's going to make you even further comfortable. Okay, so I want to take a minute and incorporate the Thinkorswim desktop application and the scanning tool specifically. So we're going to navigate over to Thinkorswim here. And let me see. There we go. So I've got the Thinkorswim desktop application loaded, ready to go. What I have also done is detached a scan tool right off of the page. So I went to, let me show you how I did this quickly. I'm going to just slide this over. So go to this, over to the scan tab, and we are on Stock Hacker. And so for our purposes, I just went ahead and detached it right here. I went up to the Actions button, hit Detach, and that gave me this. And then I went ahead and built a bit of a screen that's going to help us out. So I'm going to load that. Let me see here. At least I thought I had loaded it. I'm going to go into my personals here for us. Oh, there it is. SPX and PE ratio. So really all I've done here, everybody, is just try to give us a way to incorporate price to earnings ratio in review of S&P 500 stocks. And I've also incorporated volume as a means of ensuring liquidity here for us, right? That's, like I've mentioned, is one key component we wish to incorporate. But the only other thing that I've done is to incorporate a study that suggests that the prior day close was above a 200-day simple moving average. And again, I recognize we haven't gotten to the when to buy portion of the series just yet, but as in a very brief explanation, the 200-day moving average is the average price per share the stock is traded at over the last 200 trading days. That's an approximation of 10 months. As a round figure and a commonly utilized value, the 200-day simple moving average, as it's called, is commonly used by traders and investors as a determining factor in whether a stock might be in an uptrend versus being in a downtrend. Stocks trading above the 200-day moving average may be considered to be in an uptrend. Those trading below that same moving average may be considered to be in a downtrend. And we will talk about that in much greater detail. But I wanted to incorporate it nonetheless because I wanted to create a list that was going to be a little tighter for us here in use of the scan tool. So custom study to trade above the 200-day moving average as a starting spot. Average volume of the last 50 trading sessions, at least 500,000. And by the way, everybody, when you go to add your filters, I'll just point these out. These are appearing, you need to designate these as studies, right? So if you just hit add filter, select study, it's going to give us by default that ADX crossover. That's just alphabetically the very first one there. Hit that pencil, and then we get this pop-up window. And here we can start to add our conditions that we want to see. So I'm going to delete ADX crossover. I'm going to hit add condition. And this is where you would designate things like am I getting enough volume per share, right? So here, going into study, and then I could type in volume, so I could cheat a little bit here. So here we go. Oh, you know what? I'm in the wrong spot for volume. I've already done this. So it's this drop down, excuse me. This is where what I wanted to show you all. Changing from ADX crossover, coming down to volume and designating average volume. My apologies, everybody. So average volume here is where it's going to default to that 50 period. You can change that to anything that works for your time frame. So give consideration to that. The other thing that I did do with the custom study, which was the close, I'll show you here real quickly. That is this custom, which again, we will delete that ADX, create a condition for study specifically so that I can, not study specifically, price specifically. Back that out. Because we want to choose the closing price of the security, by the way. So in this case, so the close, this close is going to be, if it's after today's market, it's going to look at today's close. During market hours, it's going to be looking at the last trade, essentially, and decide whether is that close greater than, and this is where we define that study once more. Again, I'm just going to say simple for simple moving average. So, I've already got that 200-day simple moving average up there, everybody. Why don't I just add one for fun, just to say, hey, I want it trading above. This way I could say I want stocks that are trading above both a 50 and a 200-day simple moving average. So I know that there's going to be some questions stemming from that. Again, the trend analysis portion here, but I like to add it because my hope is that it's a tease that maybe brings you back for the class next time when we get to dive into the trend analysis portion. So, all right, so we've just built a fairly standardized, very basic scan, incorporating what we've covered, and then in the last one is that price to earnings ratio, everybody. So price to earnings ratio between 10 and 20. Feel free to manipulate this as you like. If you wanted just to simply say, as little as 1, you could. You can absolutely do that. Say 1 to 20. Notice my matches went up from 140 to 149. But once I hit scan here, I'm then going to use all of these specific details to give us a new list. And that list is only 55 stocks. Now, one thing I have done here is I did customize my columns. So see this little gear icon, everybody? We can hit that gear, hit customize, and then I added in all those ratios that I wanted to see: price to earnings, price to cash flow, price to book. I even incorporated dividend yield, just as a measure, something else I could keep in mind if I wanted. These, of course, are going to be part of your drop-down menu. Here, just slide on down to stock fundamentals to start scouring through all of these. You get a lot of options, a lot of things you can incorporate here in your columns. And remember that when you're working with these columns, they are all sortable. So now I might have a list that I'm working from, but I've also got a sortable list that I can see, all right, this list is all of these criteria, the 55 companies that meet this, which one has the highest book to value ratio, or price to book ratio, pardon me. Which one has the highest price to cash flow? Which one has the highest PE? Or better yet, maybe the lowest PE, right? Which one of these am I devoting the least amount of money for a $1 return in earnings? That's one way to look at these ratios. Now, this list that we've created can, by itself, become a new watch list. But you have another option. So I'm going to show you two things here, everybody. If maybe you're new to utilizing the Thinkorswim platform, Wiley, my answer to that very quickly is yes. I just wish I had the time to show you that here, but yes, believe it or not, you can. This platform is extremely powerful and just takes a little bit of knowledge. One of these days, we will show that, absolutely. The Horner rule, so to speak, closes over a certain level that you've designated to be resistance. That just can give investors and traders a little bit more confidence. If you if you close over a certain price level 3 days in a row, for example, that could be an option that some investors are looking for. That might be something I have to build for you guys. So, as I mentioned, we can create a watch list right from here for these 55 companies. I'll just hit save as watch list, and then that watch list becomes available to me here on, let's see here. Don't have a pin option on this, so I can't keep it at the forefront. I'll just slide it over real quick. So over here, if I save this as and give it a name, it would appear in any one of my personal details. But your alternative, and this is where I think it makes more sense, everybody, your alternative option, oops, getting a little fast here, one more time. Your alternative option is, instead of doing it from this menu button, okay, we go up here and the top one, and you hit Save, Scan, Query, and you give it a name, okay? Now, where did that box go? There it is. Give it a name that is easy to read and easy to remember as well, okay? So I titled it SPX PE ratio. Now, it's already been saved for me, okay? So when I want to look at this in watch list format, let's say I'm going to go over to this one called value that I've got, and I'm just going to go up to my personal, and I'm looking for SPX, PE ratio, etc. But there it is. But notice that little pink circle there? That tells me that I have a dynamic watch list. That means that if I made this watch list for any reason, every day I come in here, I could be looking at a list that differs from yesterday. I could have a whole new series of individual equities that fit. This is dynamic. It's just going to give me the companies that meet all those criteria every single day, right? So these are opportunities you have to improve your monitoring process in working with things like the scan tool and building in the watch list that's dynamic in this way can be really, really helpful. Now, I can save this particular, or share rather, this particular one with you. Now, I have to point out, as Ben has for me, that any of these items we share, we can't guarantee them for their accuracy, nor can we encourage you then to use them, of course. But they can help you out. And really where I find them to be most helpful is if I give you this criteria and you start playing with the available criteria a little bit. My hope is that you take away from it that it's not as hard to utilize the scan tool as it might appear sometimes. One other thing that I want to point out as it relates to using the scan tool here, everybody, is that the opportunity exists even further to move down the spectrum of the S&P 500 into a given group. And so if you knew, for example, that you needed some semblance of monetary exposure to an area of the market, you might choose to do an intersection with a given area of the market. So let's say, for example, that you've done your review, you've determined that your energy investment is light relative to a model against which you're basing decisions. You might want to follow through and look exclusively in energy in lieu of the entire S&P 500. And not only do that, maybe what you do is you've built yourself an individual scan like this and save it as a scan, right? Save it up here as scan query for energy specific. And then you save one for technology specific. And then maybe you save one for financials and one for materials and so on and so forth. And then your watch list become nothing but dynamic in meeting the criteria that you want to see for your investment concepts, right? There's a lot of steps you can take to reduce your effort as you move through your week to week, month to month, year to year process, everybody. A lot of good choices for you here. Okay, so there's your scan tool. I will save this and share it with you all. Actually, I've saved it already. I am going to share the scan with you. But just remember, as we have stated, that it is not guaranteed for time nor for accuracy, but I wanted you to have something that could be useful. And by the way, when you load it, you might note here, you may need to push this down. There is a delineation here. And when I loaded it this first time today, I had to do this. So you might need to get that double-sided arrow and open that page up a little bit. So just keep that in mind, everybody. All right. So here you go. There is the form, the actual link for importing. And you remember you do that via setup, open, shared items. Now, the last thing I have time for today, everybody, is a very quick look at schwab.com. Remember, when you are logged into Thinkorswim, you have the link right here to go directly to schwab.com. So you can click that, get yourself access to the website. And here on the research page, we are on U.S. markets. I'm going to take us from research, though, to research tools real quick. And remember, when we're talking about these ratios, the return on equity and price to book, price to sales, so on, the stock compare section is a wonderful spot for us because we can use this to load in companies in the same space. I was leaning into energy today simply from an example standpoint. I just looked at the top 5 largest in the space, grabbed Exxon, Chevron, Conoco, Williams, and EOG, and put them in here. And now I've got an opportunity to work through a number of these key components, summary, fundamental details. Here's a lot of these ratios, but I'm not stuck right here, everybody. It just makes it easier than maybe what you can perhaps pull out of Thinkorswim from a visual standpoint. I feel like this page goes a long way towards bringing that data together and making it a little bit easier on us to analyze and see these companies side by side. So yes, you can default to working right here from the summary, but you can also get granular at your preferred level. Come into custom and basically build the columns you want. Just work your way down each of these. Check marks in the ones you want, the ones you don't, leave alone, kick them to the sidelines. Consider when you're looking at ratios like this and data like this, you may want to consider looking for years of data, rates going up, right? 3-year growth versus 5-year growth versus 10, as opposed to, hey, what was it like just the most recent quarter here? You might want to give consideration to longer windows of time and a potential trend that could be developing for these underlying companies. So wanted to make sure we highlighted that for you here, everybody, from a comparison standpoint. Really, really good, easy way to pit these companies against one another, particularly when you're ready to do so on a peer-to-peer relationship basis. I think that this page does a nice job of bringing this up. Now, also, when you're here, it can be easy to forget how you got here or where we want to get back to. Just hit that little double-sided arrow, and that brings us right back to the stock page. And we can start working from here too. So if you want to start working from the stock screener tool, for example, you've got a series of preset screens that you can start working from. Any of these are going to be customizable too for you. So you can start from the near price lows, for example, and then just start building in additional criteria from the left. So could easily find that a starting spot list of intriguing opportunities can be whittled down based on criteria that you want to see from the equities that you'd be interested in investing in. So I hope that there's been some knowledge gained here today from this particular class. Again, I remind you that this is just one of a series here on getting started with stock investing. And I hope you come back and join us next Thursday as well as beyond. But in the meantime, in the archive, remember, you do have a number, good 25 plus or longer or more perhaps, from Connie doing this session over the last few months as well. And those are available in the archive there. So check those out. Watch those classes, bring those questions to the table for the next class here, which we will get going again next Thursday. So with that, I'll thank you all for being here. Hit the thumbs up button for me down below. That helps us out in the algorithm, particularly on the archived views and getting additional viewers able to see the video, those you learners out there. It's a big community of learners, and we want to get out to as many of you as we can. So follow Ben and me on X at Ben Watson CS and at Kevin Horner CS. We would appreciate that. Thanks so much. I see so many great familiar names in the chat today. I'm glad you all made it. Thanks for being here. I'll be back with you tomorrow morning for Trader Talk in today's market. I look forward to seeing you all again real soon.